we go.
Well, today I'm here with Frank Kidenya. He's a fellow financial advisor. And we're doing a bit different today because we have caught up a few times and just been chatting about what's going on and the challenges our clients are facing. And we thought we would talk about how to future-proof your finances. So it's not really an interview. It's a nice conversation that both Frank and I have sort of thought about and talked about, and thought it's really valuable for people to actually have a listen in, no matter where you are. You don't have to be in Australia. You know, everyone has a sort of retirement savings plan. So what we're sharing is a really good ways and ideas on how we can actually get through times like this. And in the past, we've had the GFC, so we've seen some serious ups and downs. And the ones that we're facing, we don't know how long this is going to last. So this is a really important time to think about how we can get our finances in order and how we can manage that through the rest of our lives. So Frank, we were talking, the first thing, the key thing was cash flow and savings. I straight away go into the whole interview state. So you can just stop me.
Isn't it?
It so is. You just stop me. But we were talking about how important cash flow is, and I focus on that first and foremost with my clients because I see it really gives me a big picture on where people are at with their finances. How do you deal with that with your clients? And what strategies do you use?
Yeah, so I mean, one of the first things I think about with every client is that do they actually know where the money is going? Right. Now, most people have got no clue where the money is going, right? So it's getting a hold of all of that. Now, I don't have time to go through, credit card statements and things like that, but actually asking people to sit down and actually write, even for an entire week or even a day, where they've actually spent money. It's actually incredible where you find how people spend money. And I find even for myself, I was, being in lockdown, working from home, I've come from an environment where, you're in an office all day, you 10 o'clock, you get up, you go buy a coffee, right? Lunchtime, you're going to get some lunch. And so you get into this habits of spending money. So I found myself the other day, I'm at home and I felt like, I need to go out and get a coffee. So I went out to Westfield and of course you get a coffee. And then you think, I need to get something for lunch and the kids need X, Y, and Z. And before you know it, I'm coming out and I've done a full shop.
Yeah.
Right?
That happened to my husband yesterday. He came, was it yesterday? Yeah. He came in and went, I've just spent nearly $300 at Woolies. I'm like, yeah,
exactly.
It happens.
Yeah. And the issue with that for me was, it wasn't just the one day. 2 or 3 days later, I've gone in and done the same thing. Right. And before you know it, I come back and I look at, well, hang on a second, what was my weekly budget towards grocery shopping and things like that? And I had spent 3 times the amount. And so writing down where your money goes, you can actually really find some of the habits that we have. I think sometimes we just have habits, right? So we spend money. Yeah. And being in lockdown, I think we actually spend more money than we actually think because we want to get out and go and do things like that.
Yeah, people get cabin fever sorry, I interrupted. People get cabin fever or they want to they do online shopping and So what I do with my clients is I get them to, it depends on what work I'm doing for them. Some clients actually hand this to me and go, look, show me how to do it and I'll look at 90 days. I either get them to look at their 90 days of transactions or I do it. And I do it in a spreadsheet and then I can see, like I will basically order it out and I can see their fixed expenses. So, they can see AGL, then you've got Foxtel and you Telstra and you can sort of see what actually comes out every month. So you've got 3 months worth of that stuff. And then you can start seeing the coffees and the lunches, the dinners out, the online spending or, childcare costs or whatever the case may be. So once I've got all that information, I then really get an actual figure. Look, this is what you spend on fixed. And that goes out of one account. This is what your variables are. That means every week or fortnight or month, whatever cycle your pay's in, is all you've got. That's your net that you can play with. That's it. And then there's a savings bucket that I make sure that there is an amount that goes into a savings.
Right.
So like we discussed when we did the last podcast with you, you know, we need to have that safety net of savings for the rainy day. The rainy day's calm. COVID-19 was the rainy day for the entire world. So we now are all aware that there's going to be a time when the money runs out, the income stops, all of that kind of thing. So what and how much is that going to look like? Well, everybody's different. But going back to look at the fixed costs is the first port of call. Going critical. Mortgage or rent, you know, the electricity, the phone bill, those things that have to be paid. That's a first insight to really know, okay, if I have no income over the next 3 months and we're because of lockdown and I'm on JobKeeper, how much was I supposed to really have in my savings? We'll have a look at those fixed costs over the 3 months. That's a great start, and start working on a savings plan to ensure that you've got those 3 months, or if even better, 6, and going on. That's sort of my theory on the cash flow plan that I do with my clients.
Yeah, and I think as well, like for most people, you know, you've got a secure job, you know, your income is coming in every week. You never really think about that day when, you know, you're not going to have a job. Like my next door neighbor here, she's a flight attendant for Virgin right now. She never thought, and it's a big airline in Australia, reputable. It's an airline. It's a blue chip company, right? She never thought that her job would be at risk. And you know, and I've seen what she had to go through. Effectively, she had to go retrain. Luckily for her, had a background in nursing, so she was actually able to go into the COVID for her. She went to basically like a hotel where you got lockdowns and look after people because of her nursing background. But for her, it was a big shock having basically one day just being stood down and saying, well, there is normal work for you. And she was able to bounce. But I'm thinking there are so many other people that have got no safety net. There is no rainy day fund at all. And mainly because we've always had money coming in, there's always a backstop, right? But I think COVID has really simply highlighted that we actually can't survive that long without money coming in. Even the companies that we actually work for, they can't survive that long without money coming in. So it highlights how important it actually is to really have that safety net aside.
Absolutely.
So I definitely agree with you there. Yeah.
Yeah. And speaking of safety nets, we talked about future-proofing our finances with insurance. Now, you and I have done a big full podcast on that, so I won't talk too much about that, but that is also something that's really important. When when we first went into lockdown, a lot of people contacted me and went, I want to just check on my income protection or update it to make sure that my sums insured are correct. Because, you know, that a lot of people who I've been saying, get this sorted out, all of a sudden started listening to me and going, oh, you're right, we've got to get this done. I just sort of think it's a critical thing. So if you want to know more about insurance, please do go and have a listen to the podcast that Frank and I have done. But income protection is also important. There's a lot of misconceptions, as you probably know, that people think income protection can step in if you lose your job. That's not the case. It is if you cannot work due to accident or illness. So anything that's going to prevent you from working because you're physically unable to. So those who do suffer from COVID, for example, and it's severe, and as we've seen all over the world, it could be, that's where income protection would be able to support you.
Yeah, and having a family, one of the things that having gone through the whole claim process myself, one of the things that I find really interesting is that you're focused on your recovery, but you're not worried about you. You're actually worried about the well-being of your family, right? So the other side of income protection is that it gives you that sense of security that you can actually focus on your recovery and not worry so much about, am I going to lose the house? How am I going to make the mortgage repayments? And for a lot of people, they're having to come back to work too early. I certainly came back to work too early. because I kind of felt like I want to go back. But probably, 2 or 3 more months would have been fantastic for me just to fully recover, get your confidence back and things like that. But
Yeah.
yeah, so definitely agree with you. Most people, and people think about income protection from the point of view of cost, right? How much does
Yeah.
it cost me? How much am I paying for this? And it's mainly because it's one of those things where you don't get the benefit of it right now, right? Um, like I'm doing this fitness program right now, and early on, I'm struggling. I'm not seeing the results. I'm not getting fit. And then I had a workout just the other day, and I felt like, oh, this is fun. I'm getting fit now, and it gives you that more confidence to go and do more and work a bit harder. And so I liken that to when I can't work. Well, I've got somebody else who's working very hard for me, and that's how I view, the insurance piece, and
Yeah.
certainly looking at, coming back to the budget as well, is thinking, well, how can I make room in my budget to basically afford the income protection? And if I really can't, is there any other ways to structure that way I've got some safety net, which there are, being advisable,
Yes.
we know about those other ways, but
Yes.
it's actually making room for that, and making it a priority in your.
Absolutely. And I do encourage anyone who's listening to seek advice around their insurance plan. A lot of people think it's as simple as just going online, something like Choosy or whatever,
Real
and just
insurance, yeah,
a real
yeah,
insurance. But it's important to get a professional to have a look at it, and also look at the affordability, because you don't want to get
yeah,
in a situation where you've got insurance and then it's not structured to fit your budget, and all of a sudden you can't make the payments, or and it's lapsed and you think it's still going, and then you don't want to be in that position. There are ways of structuring it so you've got it in place, and that's the job of the advisor, to really assist you with that.
yeah.
Now,
Mm,
speaking of advice, one thing, I'm going to go backtrack a bit about this safety net. One thing
mm,
I do with my clients is when we get to a certain level of savings, then we look at, okay, you've got this really good habit now, a really good discipline of saving every paycheck. So now we want to actually look at savings to invest. And this is another incredible way of future-proofing our finances. Now, before anyone rolls their eyes and goes, hang on a minute, I'm on JobKeeper, or I have no income, or how am
mm.
I supposed to invest? Well, we all have an actual investment plan, which is in the way of superannuation. So
Correct.
be
Yeah.
mindful of that. So when we're talking about investing, there are other options here, not just about investing outside of super, or if you're listening in, so in New Zealand or the UK, you've got Kiwi pension, Kiwi Saver, the UK pension, 401k in the US. So there are these safety nets there that actually invest money for you. So it's really important that you find out how your money's invested. But this is a subject that you and I really got carried away in last time, just on our phone call, about how we can, as advisors, improve our clients' investment portfolios in these this current environment. So I'm going to, because you really love all this stuff, so we're going to go into a bit more detail about, things to look at when you are investing. And please note, this is a disclaimer. This is general advice. You need to speak to a financial advisor about this stuff. But what we want you to do is actually start questioning what you are invested in, how where you're at, how many assets are they diversified, all of those kind of things. And what does it mean to be conservative, or or defensive, or on the other spectrum of growth or aggressive?
Yeah.
So I'm going to give you
Well,
you take it away there, Frank.
yeah. Well, so I had a client just over the past 2 weeks, and single mum, got 2 kids, and she works in childcare, and so she's not earning a lot of money, and literally living day to day, week to week. And one thing is that she found herself in a bit of difficulty, right? She couldn't pay her car, so her car got repossessed, and of course she got on the phone with me, and I helped her out with that. And then one things that we spoke about was, well, hang on a second, if you're struggling today to pay for your bills, what's your plan when it comes to, because she's now 42, right? And I'm thinking, well, you've only got so many years that you really want to work for. You know, how is your super going? What's your long-term investment savings plan look like? She goes, well, I've got no idea. I've got this super thing, but I've got no idea how it works. I don't know how to make it work better for it. You know, I've got no idea how to make it work. So we spoke about how super works, and we did, you know, a budget for her as well. And it was tough, but she can afford $50 a week, right? And for her, it was more, okay, I don't see it. I'm happy to put $50 a week into it and let it work for me. And it turns out that based on how she's going at the moment, and likely she's young, she's been able to do this early, just by putting that little bit extra into her super and paying a bit more attention to it, that she'll get into a place where she can effectively replace almost 75% of her current income in retirement. Right?
Wow.
Now, she didn't see herself as being somebody with money or somebody who can actually have a comfortable lifestyle. So simple things like that, it can actually really help and really make a big difference in the long term. The other part was, I was speaking to an older couple, and they're in early 60s, and asset rich, cash flow poor. And what they wanted to do is basically get some money out of super to help them with you know, daily living expenses, mainly because they had planned to downsize their home. And unfortunately, fortunately, their home is under compulsory acquisition from the government. So they can't do anything with it now until that goes through. And that could be 2 years, 3 years, 4 years, who knows. So we spoke about, you know, how to go about getting money out of super, which was fine. But then I asked them, so, you know, how do you feel about your investments in super? And she said, I have got no idea, no clue. So again, I went through the process of, you know, educating about how the investments work within super. And after that, they kind of felt comfortable with where the money was at. So I guess what I'm highlighting here is education about the different types of, number one, you know, where is my money being invested and how does that investment work and what are the risks with it is very, very important. And you don't have to know a lot, but you do have to have some sort of understanding of what's a growth asset. You know, what's the risk with a growth asset, right? And do I see myself as somebody who is a risk taker, or, you know, do I see myself as somebody who's very conservative? And if I'm either one, what are the pros and what are the cons of it? And really, an advisor can really help you with that. But I also feel that, you know, people need to, you know, a lot of my clients, I do, before I make any recommendations, I want to make sure that they understand, you know, what that means, because ultimately that whatever decision they make today would impact the outcome they get at the end. So
yeah, 100%. Well, we're talking about doing a webinar, and this is absolutely one of the most, like, the hot topic of that webinar, I believe. We could actually even go through showing people a statement and breaking down what the asset allocation is, and that meaning where the money is being invested. So assets are, you know, could be property, could be, you know, direct shares, so equity, and they could be overseas, they could be international or domestic. So on your statement, you'll see a pie chart, and on that pie chart, it'll actually have a breakdown of these assets. Now, one of my clients came to me very early this year, just before COVID, and his super was doing really well, and his wife, they were both doing really well. And I did my research and had a look at everything, and I thought, oh gosh, one of the investments. So he had 2 super funds, and he needed to consolidate one of the super funds, which was the highest value, so highest balance there, was in only one asset class. When COVID hit, because there wasn't diversification, which means multiple different assets, so that, you know, some assets are going to do really well in this kind of environment, some are going to do not so good, that it evens out and sort of at least is still going up. because there was only one asset and that asset value went down, there was no other assets to offset that downfall. So when it came to COVID and you know, when really things went sour for us in March, you know, that loss wasn't actually recovered. That loss, whereas everywhere else I saw, when you've got diversified investment, there was recovery because it was in one asset. So it's really important to understand how your super is invested or how your retirement savings are invested. And it's really important to consider being diversified. As they say, don't put all your eggs in one basket. So that was a big lesson. For me as well, just to, you know, I've got to be more pushy as I didn't realise we don't know what's going to be happening around the corner. We weren't expecting COVID to happen. So meeting him in February and seeing this situation, I've gone, well, that's not ideal. Come back to him. This is my recommendation. But his decision-making was very slow. So then this happened. And I wasn't pushing and pushing and pushing. And I sort of go, there's a loss of opportunity there. I could have pushed harder, but does that mean that he's going to make those decisions faster, or would that put him off? So you've got to also think about when you're getting some advice, what the ramifications are in not taking that advice up as well.
Actually, that's a really good point. That's a really good point.
Because there is always going to be opportunity or loss of opportunity. That was a big lesson for me in this year with what's happened as an advisor, and a hard lesson for my client as well. What we've had to do is re-strategize his retirement plan. It's only extended his retirement plan by about 18 months because we're also doing more salary sacrificing for him, you know, and so it's okay, but it has definitely set him back a little bit. But what, you know, the other factor is the mindset. It's that fear, and, you know, we've seen that happen before, and people get very scared. So it's really important to be on top of these things so that diminishes the fear as much as possible.
Yeah,
and have these conversations with professionals.
Absolutely, and doing it. There's one thing that's certain: we're going to have more disasters. We're going to have more issues come up, right? But we've got no idea what kind of returns we're going to go and get, right? So what that really means is that it's very important to be really well diversified. And what I tend to find with my clients is that I tell them, you want to make the decisions about what you're going to do when, you know, things go bad right now. And the reason why you're going to do that right now is because you're in an emotional state to actually make a good decision, make sure your portfolio is well diversified. It's too hard to do that after things have gone bad, right? So you buy your insurance before the hurricane comes in. And when the hurricane comes in, well, you've got the insurance in place already, right? So that's how I kind of view it. And what's really interesting about, if I look at what's been happening, especially for retirees, right? Over the last 10 years, we've preferred having money in a bank account, right? So in a term deposit, it's been the preferred investment. Why? Well, it's safe and I get an interest rate in return. And that's going down to zero now. I mean, you invest money in a term deposit, you get no money.
Hardly anything.
Hardly anything, right? And the other side to this, people have gone to, well, dividends. I want to go and buy, you know, bank shares because they give me nice good dividends. And what we've seen through COVID, they've been halved, right? So if everything was in that one basket, then all you're seeing is that you know, your income and your investments are being impacted. So doing it early is very, very important. The other strategy I think about, especially for retirees, is dividing their super into different buckets, right? So as an example, you might have your income bucket. This is the money that I think I'm going to be drawing on a regular basis. And typically, there are different ways to do this, but typically you want to have maybe 1-2 years worth of drawings in a cash style, in a cash investment. So what you're saying is the rest of my money is invested, it's working for me. This is the pot that I'm going to be drawing on and using for the next few years. So that does two things. It gives you certainty, right? So I know my income is secure regardless of whatever is happening with the market for the next, 1 or 2 years. Any big expenses like, obviously it's holidays, maybe not now, but maybe you're going to go and buy one
Upgrade
of
of
those.
car.
Yeah, absolutely. So all those type of expenses, you want to have that money in cash because you never want to sell your super to get access to that money when markets are going down. So that's the first bucket. Then the second bucket is more your, what's my 3 to 5 year expenses? So let's say I'm spending $50,000 a year. Over 5 years, that's $250,000. Well, that $250,000, I want to have that in an investment that gives me maybe slightly secure return, but maybe slightly higher return. So typically, I would have that in more like your government bonds and things like that, where it's there, it's secure. So what that does for my clients is for 5 years, their income is secure. So regardless whatever is happening with the market, they never have to worry about where the investments are for the next 5 years. They can still support themselves. And then what's left over, I guess this is our growth bucket. This is the start. This is the bucket that we're going to try and make work, make it grow, so that over time their superannuation lasts for as long as possible. And then, every year we rebalance the buckets, we top the buckets up and so forth. But that's one strategy that some of my clients have been looking at to make sure that they're managing through, the markets up and downs, and the lifestyle is protected, and their retirement savings are also doing what they should be doing, which is providing them with an income to support their lifestyle. So that's another strategy that I use as well.
That's a great strategy. I do something similar, but not at like the 5 year period. I have that all together. So I guess it's still in a bucket, but I've just not ever articulated it like that. I like that way because so I'm learning something here because it's all about how we share this information, and because again, it's a mindset. We've all got to understand it. Where if you understand it and it makes sense to you, you're most likely it's going to work for you. So that strategy. I mean, obviously that I've got my investment in sort of a platform and it's all there. But if I could actually just divide it and say, well, that's what this is, and this is the growth part of it, and there's the income. I do exactly the same thing.
Yeah.
I just have that money sitting outside in a cash style, sometimes in term deposits, but it's there, it's liquid, it's available when you need it, because there's nothing worse than having a client contact you and say, I had a credit card payment and I couldn't actually make it.
Correct.
And so it's available and ready to go. And if they want to do a big drawing, sometimes I've got, clients will call me and go, okay, I'm thinking about upgrading the car. Can I? And it's like they're asking me for permission. It's their money. Of course they can. But what they're asking me isn't actually whether, I'm not in control of their finances. It's, again, giving a sense of certainty and,
is this going to affect my future, my savings if I do this? Yeah.
And it then is a great opportunity to have that conversation and go, well, this is how we've got it worked out so that these items can. And if there was a bigger, drawing than what we'd planned, then we've got to do what we've done with that client I spoke about. We've got to just restructure things around and go, okay, we might have to adjust the strategy or look at the timeframes that we've put in place and go, that might not happen. Excuse me, I'm a bit under the weather, so.
No, you're okay.
So the other thing is talking about timeframes is these scenarios we deal with, like COVID or the GFC, or we've had some bit of volatility over the last decade. When they happen, they affect people's investment returns, and that can cause a setback. So the challenge we're faced is finding the right investment strategy and ensuring that it's diverse, it's meeting the client's risk profile or risk appetite, meaning are they comfortably enough when the markets are volatile to be at a loss at some times and a gain at other times, and are they prepared to ride it out for that period of time, and how long are they prepared to ride that out for? So these are important things to understand when you are looking to invest and actually put a plan together. So I hope I'm not talking too technical here, and that's why I would love to have feedback to this podcast, because we will be building a webinar, and if people are really interested, we'll keep doing them because I think, as you've said, Frank, education is key when it comes to our finances and future-proofing our finances.
Yeah, and for most people, for most clients, they don't have to know the little minute details about how financial markets work. They just need to understand, how is my investment invested? Number one, where is it invested, and what potentially can I expect, the good and the bad?
Absolutely.
Right? Most people are simply looking at, oh, what's the return on that? Oh, it's got 10%. Oh, great, I'll put money into that. But it's really understanding the good and the bad. And that's what really helps you to actually do well over the long term effectively as well.
Yeah.
Yeah, so I spend a lot of time with my clients, just really giving them a good, I guess, educating them on my framework of how I go about investing in the portfolio, making sure that they understand and actually buy into, my framework of investing the money for them. And then, and then go from there. But it's critical to understand it. Absolutely.
Absolutely. Now, speaking of, returns of investment, interest rates and everything, and time, it just occurred to me.
Before you move on,
oh, yeah, sorry.
Before you move on, I was thinking about something about, so Melanie, we've been talking about, budgeting and super and so forth, right? The other thing that I've been talking to my clients about, especially the younger ones, right? So the clients that maybe you've got a family, you might have a mortgage, and you're looking to grow your wealth over the long term. One of the things that we spoke about earlier was interest rates are so low.
Yes.
Maybe this is where you're going. So
I was going there.
You're going here, right?
Yeah.
So interest rates are so low, right? And not only that, there are so many lenders at the moment out there, whether it's your banks or your fintechs and so forth, who are offering very, very competitive interest rates. So anybody who has a mortgage and they haven't really looked at they haven't negotiated a good deal with their bank, that's the first thing I'll be doing right now is
100%.
Can I lower the rate on that mortgage? And because that will do two things, right? The first thing that will do is, it's going to lower your interest repayment, which means if you continue to make the same payment as you've been making, well, you're paying off that thing a lot faster.
Absolutely.
Right? And
you're creating an asset that you own and not a bank.
And not a bank. And most of us, the goals that we have is I want to pay off my mortgage. Well, this is now the opportunity of a lifetime, right? Interest rates are as low as probably likely going to be. We're not going to see negative rates. Negative rates, how will that work? Probably we're not going to see that. So we're probably as low as we're going to go. So you should really be refinancing your mortgage and getting that rate as low as you can. And you can approach your current bank, or there are typically mortgage brokers out there who will shop on your behalf for a good deal. And that's a really good opportunity for people to start doing that right now.
Absolutely. I mean, debt reduction is a massive thing that I focus on with my clients. I've had, we've all seen the good, the bad, the ugly. If you've got a mortgage and you've got credit card debt and personal loans, my advice would also be, if you can, and you've got enough equity on that property, to refinance and clear all your debt, because the banks earn the most of their money out of credit cards and personal loans. They're not making, they are making money out of the interest on mortgages, but if they're low and you're looking at 2.9%, for example, versus a credit card that's sitting nearly at 20%, clear that debt. And if you think, oh, but it's a safety net. No, it's not. If you actually think about it, you understand how compounding interest works. Your credit card debt's pulling you backwards, whereas your savings and investing is pulling you forwards. If you've got a bit of both, you're going nowhere. That's how I look at it. In fact, you're probably taking 2 steps backwards and only 1 step forward if you actually are using credit cards. So my advice would be, get rid of them unless you've got a point system and you clear it every single month and you have that discipline. Then my advice would be, get rid of them. And banks would probably hate me saying that, but it just makes no financial sense. If you are like, you like to buy things online and, luxury items can be a bit of a hit to your weekly, fortnightly budget. Look at things like Zip Pay or Afterpay, which don't have the interest rate like credit cards. And you can actually incorporate that into your budget. Yeah, you can incorporate that into it.
Absolutely.
Yeah. So these are little tips that you can consider on how do I get a handle over my finances and future-proof myself, so that you've got that. We go back to the beginning of the of this podcast and think about the fixed and your variables and your savings. If we can get you in a place where you've got a really nice, comfortable savings safety net, and you've got your insurances and you've got your, everything's running smoothly, automated, bills are being paid, your variables, you know exactly what you can spend week in, week out, then you grow from there. You can start building an investment plan. So you've got your mortgage refinanced. You're knowing where you're going with your super. You understand how you're invested. Once you've got the handle of that, you'll be able to take your own personal finances from just a savings account that's earning absolutely no interest to something very similar to how your superannuation's invested, and maybe you have a growing investment plan as well as your mortgage. So there's all these things you can build on top of to keep growing.
Yeah, and the other part to this as well, what's the name? Warren Buffett says, be greedy when other people are, being scared, and vice versa, right? And I was thinking about this, and, the clients that I've had that have done really well, they've done very well when there's a crisis, right? And the reason why is that in times of crisis, they've had a safety net, they've had money aside, they had the right investments, investment asset allocation from the start, which meant when an opportunity, so they don't see a crisis as a crisis. For them, a crisis is an opportunity to go and buy stuff on sale, right? So they've been able to, invest in, at a time people are very, very scared. And in turn, they've been able to, make a lot of money. So the upside to having a safety net is not only that you've got your safety there, but when opportunities to take advantage of really good, I look at, where shares were back in March and April compared to where they are today. And you're like, only if I had put in $20,000 into Afterpay, I'd be 10 times as much, right? So it's those opportunities that tend to come up when you least expect them, but when you're prepared and you've got a good plan in place, you can take advantage of them. And that's the one thing that people don't really think about. And I also remember back in 07, in 08, when we had the great financial crisis, right? Markets came down very quickly and all that kind of stuff. And I remember in 07, I'm not sure if you recall, this is what was when Peter Costello said, people can put in $1 million into super, and they had to do it by June 30.
Those were the days. I remember that. I was at St. George at that time, so I remember that.
Yeah, and I remember, so, how much people put money into super in 07, and of course, it went down afterwards. But the thing was, interest rates came down very quickly. I remember interest rates at 7-8% for mortgages, but then we had a GFC and interest rates came down very quickly. But you and I, your Gen Zs and your Gen Ys, but I look at what actually happened to property after that, right? Before that time, property was just going up and 5%, 4% a year. But between 07 or 08 and call it 2 years ago, 2018, property prices doubled.
Yeah.
And so I'm thinking about all those people who had a savings plan had an opportunity to go and buy property in a time when rates are really low, right? And actually do very well. So the upside to having a safety net and being in a good financial position is that you can actually take advantage of, crisis when opportunities come up. That for me, I encourage my clients to, that's the benefit of actually being in a really good financial place, right? Is you do well when there's opportunities come up.
Absolutely. Well, as you said, there's been a lot of discounted stock, so to speak. Now, I wanted to talk about that more in detail because we were having a chat about the where there's growth, and where there's, and where we could look at, because those who actually have an understanding of investing but don't know where to look at, first of all, I'd say get advice. But if you sort of are the do-it-yourself kind of thing, what kind of I've got a clear idea of what investments you're going to say, so I want you to share some of the investments that you think would be a great idea at this time in this current situation, this current environment.
Okay. Well, let me take a minute just to give you, I guess, the framework in which I operate under, right?
Yeah.
So I think about where we are in the economic cycle, right? And also what tools governments and central banks have to basically, get the economy growing and save us from disasters. And typically, we know it as monetary policy or interest rates, right? And fiscal policy, which is government spending. Mm-hmm. So if you think about monetary policy, right, most of us really know about rates going up and rates going down. Well, that's the first phase of monetary policy. When rates hit zero, right, and you have a crisis, they can't stimulate anymore by cutting interest rates. So now they have to go and buy financial assets, right? And so in 2007, people, you hear this buzzword QE, or quantitative easing, and all that is central banks printing money and going and buying assets, right? What does that do? That puts money back in the financial system. Banks can lend again, and we can go and get loans to go and buy homes and so forth. That's one of the reasons why we saw a big, massive increase in house prices. But then you get to a point where that doesn't quite work as well anymore. Now you basically go into a situation where the governments now have to give money to people to go and spend. So things like JobKeeper is actually, and it's a government putting money into people's hands. So what does that really mean? Well, when you're printing money, the value of money goes lower, right? So as an investor, you want to be looking at the next 10 years. If the value of money is going lower, well, what investments do I think would protect the value of my money? And one of those investments we spoke about was certainly gold, right? So gold has been a good inflation hedge. And in times when, central banks are printing money, well, gold is a pretty good investment. So I've got a fair few clients with the gold allocation. The other side to that is real assets, right? So they can't make any more land, they can't make any more property. So certainly investing, and again, I'm not advising people to go and investing in property right now, I'm just talking out loud.
Yeah.
But certainly having access to real assets is very, very important. The other side of this is when I'm looking at, if we look back at what's done really well during COVID and why it's done well, we look at these big tech companies, right? Now, these tech companies have done extremely well. And if you think about, well, why have they actually done well? Well, for a couple of reasons. Number one, a company like Microsoft, right, has got something like $70 odd billion in cash, right? Apple has $200 billion in cash, right? So what does that mean? Well, they're not going bankrupt, right? So they're now basically the new safety. So people are investing in them because they're not going bankrupt. But the other part of that is because they're so big, their cost base is so low. I mean, Microsoft doesn't really, how much does it cost for you to go and, buy a Microsoft Teams subscription? The cost base is very low. So these companies have become very, very profitable and they're good cash generators. So they've done extremely well. So, so a lot of my clients do have access to, to tech companies, and I think they'll continue to do well, mainly because they've got a low cost base and they've got this ability to generate cash compared to, I look at banks as an example. Well, banks rely on people to borrow money. And if the economy is slowing, if you haven't got a job, you can't really borrow money. So banks will struggle in this environment, right? Yeah. So that's I guess the quick rundown of how I invest. The other part to this, of course, we talk about emerging markets. And what's emerging market? Well, in China, do you know that China is still an emerging market? Yet some of the biggest companies like Tencent and Alibaba, these are Chinese companies that are more profitable than some of the companies that we know here. And so investing in emerging markets is critical as well.
Alibaba is one of their tech companies.
Yeah, tech companies, absolutely.
And it's been doing really well for the last several years. So if you're on that ride, you would have enjoyed that.
Absolutely. Now, of course, you still got to have a portfolio. You still got to have a well-diversified portfolio in that context. But this is where the advisor can help you. It can say, well, how much money should we invest in gold and so forth? And, how does that work as being part of the portfolio? The last thing I want to say there is we think about having defensive, right? So fixed interest bonds is what we think about.
Yes, correct. Straight away, fixed interest and bonds. So, and that's right now is really incredibly important. They would be in your second bucket.
In the second bucket, yeah.
Yeah. And I was going to say that, but I knew we were going to talk about this later, so I just bit my tongue.
So the last thing I've been doing there is, you can buy these called inflation-protected bonds, right? So what these bonds do is that their capital base adjusts as inflation goes up. So when the governments are printing a lot of money, typically at some point in time, that will cause inflation. Yes. So I've made a little change to my defensive bucket for my clients into more inflation-protected bond as well. So that's something, a little nuance that can actually really help people protect their portfolios against inflation when it does come up as well. So yeah.
Well, right now, I mean, I 100% agree with everything you just said. We were talking about that a week or so ago. We're building portfolio with in-house again, just with a lot of those philosophies for our clients. Obviously, everyone has their own risk appetite, so the weightings of assets would vary from person to person. So there's no one size fits all. And I know you probably do the same thing. And those who want to go out there and invest on their own, there's probably simple ways of doing it through the use of ETFs and such, where you've protecting yourself a little bit and you've got some diversification. So you can actually go and get an ETF that is in technology, for example, and has exposure to some of those assets we talked about. So that there are things that you can look into, and I spoke with Naomi Christopher from Implemented Portfolios on ETFs, and she's in a previous podcast as well. So if you want to know what that is all about, I would have a look and listen to that, and reach out to either myself or Frank or even Naomi on that topic. But as we've said throughout this entire podcast, it's imperative that you get advice. If you don't get advice, do not take anything that we're saying as advice. This is general advice only. This is merely a conversation to help people understand what's really going on and how they can take more control over their finances. So I just want to, again, the disclaimer is going to keep coming out there just to cover ourselves. Very general.
You need to seek advice, and this is where the advisor can help you. And also, absolutely. I mean, I recognize that things change. So the other part that was really important, if you haven't reviewed your portfolio in a long time, you should go in and see your advisor and get it reviewed. And as part of what you and I do as well, we regularly review our portfolios and make changes as new information becomes available as well.
And rebalance. I mean, I've just done a review on clients that have been too busy to come and see me. You send out emails, you just make phone calls, and you get nowhere. And it's everyone's busy, and we get that. It's really important to try and take that time out to spend an hour with your advisor just to get a handle on things, but understand that your advisor is rebalancing your portfolios without, that's part of the service. We're making sure that you're not going to end up heavily weighted on an asset because it's performing better than others, and then hit this kind of crisis and it falls over. You don't want to be in that position. So be aware of these things. And if you have got an advisor and you're not sure you're getting this service, certainly ask the question, is my portfolio being rebalanced? What does that mean? Right. Have you reviewed my risk profile? How am I invested? All of those kind of things. It's important, and be in control of that. Speaking of which, I was talking to a new client just
Mm.
the other day. She's a retiree, felt self-funded, and she contacted me after the bank who she's been with, who has given her an advisor on and off for years. She's changed hands she's had 4 financial advisors in the last 18 months with this bank, and obviously quite unhappy about it because she has to kind of share her story all over again and,
Yeah.
go through everything. And the most frustrating thing she found out of that was that although you tick the boxes on your risk profiling questionnaire, she understood that it may come up to say that she's quite conservative. She said, of course I've got these concerns because the finances, because her husband's got Alzheimer's, the finances are solely on me. And I have 2 adult children who need my help from time to time, and one's just recently divorced. So yes, I've got those concerns, but I still want to be invested where I can see some growth. So what she was saying was, I want to know that I've got some level of security, but I still want to be invested where I'm going to get some returns. And that information was lost on this advisor. He went with just the box ticking process, didn't understand, didn't listen to her. And what she was saying is she was wanting to be invested with some growth assets, but also keep in mind that a portion of her portfolio does need to have that security, exactly like what you were saying about the buckets, having that income, having some short, that period of time between 1 and 5 years that you've got that guaranteed amount there, and then a nice chunk of that money that's going to be in some growth, that's going to keep going and rolling because you're not going to use that immediately. That's what she was asking for. But she was put into a very conservative investment and really frustrated by that. So be mindful. We're all advisors, are here to help and make sure that when you are looking for that financial advice, that you are being listened to and you gel well with that person, because I believe it's a long-term relationship. I got this client because her daughter was a client of mine, and I've been working with her daughter for about 5 years. Actually longer than that now. I think they're going on to 7, to be honest with you. Now that scares me. So that's the point I was saying is, if you are going to seek advice, or it is a long-term relationship, so you really want to know that you're gelling with that person, they understand what you need or how you communicate.
Yeah, and I've got a story to share on that one as well. So I remember, I think I told you about this one. I had a client back in 07, and I really remember this client because she really changed how I thought as an advisor. So young advisor, I've read the textbooks, I know how to advise you. And her situation was, her and her husband had motels up in Port Macquarie. And fortunately, her husband had just passed away. And she really did not want to be running a motel anymore. So she sold that and, had some money to invest. And she actually had the opposite problem. I sat down, and I was working for the bank at the time, right? And I sat down with her, and she came out as actually quite a growth investor as well, because her experience and her knowledge of how markets work, and so she came out as a growth investor. So I remember my advice to her was, hey, you know what? These boxes of ticks say that you're a growth investor, so I think you should go into a growth profile, a growth portfolio. And she said to me, Frank, look, I want to retire. I don't want to worry about my money, right? I just want to know it's there, it's giving me a return, and I want to go into more of a conservative portfolio. I said, no, you should be in a growth portfolio. She goes, no, I don't want a growth portfolio. I want to go into conservative. And of course, as a bank advisor, you give the warnings, well, X, Y, and Z. And the reason why this client really stuck in my mind was literally a few months later, the GFC took hold, right? And I went back and I looked at my recommendations to her compared to the portfolio that she had. And surely enough, right, her portfolio had done a lot better because she was conservatively invested compared to what I had recommended to her, right? And to this day, she's still got money. She's still very comfortable traveling around the world, and she's quite happy. But that stuck in my mind, and ever since, the reason why I insist for clients to have some sort of an understanding of where the money is going, ultimately, it's their money, right?
It is.
They're responsible for it. Yes, they're getting advice and they're trusting on an advisor, but you need to know where your money is going. You need to know what the good, the bad, and the ugly of it, and take charge, right? So, and again, being listened to is very, very important. If you're not being listened to, that should not be your advisor,
That's
right?
right.
Yeah. So to me, I really second, what you've done for this client, and really listen to them and actually make sure that whatever you're recommending is actually meeting and achieving their goals, right?
Yeah. It's not always about, there's no cookie cutter scenario, outcome. We have those questionnaires, and you'll get, a lot of questions when you meet with an advisor, but that's to really get a big picture. And, we're guided and regulated by ASIC, but the other part of that is we now have FASEA, and the fact is our job is to understand our client, act in their best interest. So if the client is saying, I want to know that I've got security with the money, but I also want to be well invested, and I'm prepared for volatility to ensure the return. Right. And they sound like they're understanding exactly what they want, like this client, this woman did. It was, I just went, I'd be offended by an advisor who basically made me out like I didn't know what I was talking about. It's mind-blowing money, Yeah. It's like that's something you've got to be careful about. So our job is to ensure that you're kicking you as a client. And kicking your goals, So it's not just about investing. It's all about the cash flow, the insurance, and knowing that you've got some of these objectives that are getting met along the way. It's a short-term, medium, and long-term plan.
And also like the whole thing about, I typically ask my clients after I have an idea of their risk profile. I'll typically ask them, so what's your understanding of being conservative or risky? What do those words actually mean to you? And I had an interesting response a little while ago. I had a client that said to me, Frank, my profile says that I'm conservative. That's what my profile says. But conservative to me, it actually means I'm quite happy investing all my money in blue chip shares. I know they go up and down, but I know that those companies are going to be there, whether it's hailing, whatever. In terms of disaster, those companies are still going to be there. And I thought, hang on a second. So you should really be a growth investor, but my profile is saying that you're a conservative investor. So it's being able to have that further discussion to really work out, well, what does that really mean for you as a client? Are you
correct?
What does conservative actually mean, and what does you being risky? For some people, being risky, it's going into the casino. That's being risky, right? But investing in Tesla is not risky for them, right? So it's really getting an understanding of what that really means for each person.
Absolutely. Another thing to consider with your investing, and this is a big question I ask with in my fact finding, more so in the initial phone call that I have with the client before the fact find meeting, is what motivates and why. That conversation I had with Naomi in that podcast earlier, I mentioned the point of we were talking about ETFs is you've got to find the reason, the why. If it's a cost-effective, easy, simple way of investing, there's the why. It's not the how and the details and all the tech discussion that we could very easily fall into and spend go into the abyss of tech talk, financial jargon. The point is, why are you motivated now to seek advice or invest? The conversation I had with a client the other day, he called up and goes, I want to know how to invest. And I was like, great. What exactly are you after? I wanted to know, are you wanting to create your own portfolio? Are you thinking I'm going to be your broker, or are you seeking advice to grow and to, be, as we saw, future-proof your finances so that you've got safety nets and you're creating wealth and you've got you know, and when we uncovered it, well, he was seeking advice. He doesn't want to do it himself. He doesn't want to be the stock, you know, go on ComSec and buy shares and, you know, and watch, you know, the candlesticks move. He doesn't want to do any of that. And that's too technical. Everyone's busy. You know, we're all experts in our own field. If you want to do that, that's great. And there's a lot of courses and there's a lot of know-how. But we do some of that ourselves. But we've got between my husband and I, you know, there's years and years and years of experience with him. I have 4 degrees in finance and economics. Like, so, you know, he's got a handle over it, you know.
And you've got the time.
And he's got the time, and he's got 3 big screens. If we were doing this recording next door, you wouldn't be able to see, he's in there, but you wouldn't be able to see his face because he's got 3 big screens, because he's got, you know, the Australian Stock Exchange on that screen and emails and stuff going on there and something else going on there, you know. That's how he operates. We all don't have that you know, ability to do that. So seeking advice, understanding your why is all about actually, I really wanting to learn how to buy and sell shares.
Mm-hmm.
Do I know what I'm doing to build my own portfolio, or do I want someone to explain it, show me what they're doing, how it's being done, how my money's being invested, so I have a clear idea of understanding, so I can be involved in the decision making. They can handle it for me, and that's what we do.
Yeah. And I think, you know, clients should definitely really question the advisor. Hey, how do you approach investing? You know, do you outsource everything to somebody else, or do you actually know where my money is going? Because you're advising on that money.
A good question. So I've had that a few times. Are you invested in what I'm invested in?
Exactly right.
You know, it's like, well, you know, you've got to put your money. Really, I have to say absolutely. When, you know, with that question, I had to say absolutely yes. And since then, things have changed, you know, and what we're doing right now, and I've got a huge amount of work on my hands in the next, 3 or 4 months with all of my clients, because we're creating a new portfolio for them.
Yeah,
so,
absolutely.
Record of advice, here we come.
Absolutely. Look, the last thing I was thinking about as well, and somebody made this comment to me, right? Most people, when it comes to their money, they start planning when it's too late, right? So I look at, you know, half my clients who are approaching retirement, right? They've approached it, well, they're looking at it too late. You know, if you're looking at your super when you're 50, you've missed quite a few years, right? And so starting early is a critical thing, right?
100%.
You don't have to do as much. You actually do a lot less compared to looking at, you know, So starting early is very, very critical. And I'm thinking about, you know, my brother who is, you know, in his 20s, and the only thing that he can think about right now is just paying for his bills. But the reality is, you know, he's got goals, he's got dreams and things like that. But none of them will come to pass unless he actually sits down and actually has a plan. You know, because I think once it's on paper, it's serious. You can't walk away from it, right? So
once you know, you can't unknow it.
Yeah. So I think sitting down, studying early, and then you don't have to know everything, but you've got to know. You've got to build a team around you of people who, number one, are acting in your own best interest, right? So they know 100%. Your goals, they know you, and they're, you know, invested to making sure that you're achieving your goals. I think that's you know, so getting a good advisor around you, whether it's, you know, a financial advisor, an accountant, all these people that know you and
understand what makes you tick.
Exactly. That's very, very important. So so anybody that I've seen that has done well has a good team around them.
It's important to find your team, but as you said, it's important to start
early.
Immediately. Like don't put it off. The younger you are, the better. I have had clients come to me and they're facing retirement and they're at panic stations, and it's a really frustrating place for them and a very scary place for them when they're facing retirement and know they don't have enough to retire with. Yeah. You don't really want to be in that position. I mean, those clients actually own their own home and everything, so asset rich in some respects, but cash flow poor. But the fact is, as we talked about before, our retirement savings plan, whether it be superannuation, KiwiSaver, 401k, or your UK pension, whatever that is, so there's many others, but they're the basics that I know of, that I've worked with, whatever they may be, it's important to understand that may be one of the biggest assets you will ever own. I've been in a room full of people and I've asked anyone, raise your hand if you know your super balance, and you get a couple. Raise your hand if you know the value of your home. Everyone knows the value of their home.
Yeah.
Especially if they're like, I know the value of this house and I rent it. Because I would love to buy it. It's like it's that home that you just want to own.
Yeah.
So everyone kind of has an idea of what the property value is down the road and what the property value of average median house price is in, say, Maroubra or Kensington or Randwick.
Next door neighbour just sold. I know how much they sold for.
Exactly. I know down the road what they've sold for.
Yeah.
But I don't know exactly what my superannuation's doing.
Yeah.
I did a little post the other day on Instagram, and I did the calculations. I used an example of a woman in her 30s who was putting $15,000 towards her super, which included her super guarantee, with a rolling sort of 6% return. So because she's in growth, we expect some years to be higher, some years to be lower, but we just average that out to be about 6%. And at retirement, with just that $15,000 year in, year out, she'll have $2 million to have. Now, if we get that advice early enough, we would be laughing. There's...
And tax-free, by the way, tax-free.
Absolutely. Other countries have tax-effective strategies for retirement plan because the governments don't want to be carrying that load.
Absolutely.
And neither do the children, neither the kids,
Neither the kids,
Whose responsibility is our financial future but us?
Yeah.
Because we've got to take that and run with it, really, and take that responsibility and go, okay. And the first part, going back to the very beginning, the first part of this is getting control of your cash flow. It's very simple.
It starts the money coming in. What do you do with it?
Yep. So if you can start there and then build from that, it does take discipline, but if you've got the goals, and that's the second thing I think is a great motivator, get some goals in place. Like you talked about with your fitness, you'll start reaping the benefits over time. I follow James Clear, who does it's the, what is it called? The 1 minute. I've forgotten the book. I've read the book.
1 minute. Is it 1 minute financial plan or something?
No. James Clear is changing habits, breaking habits, and creating new habits. Atomic Habits. That's the book.
Atomic Habits. Okay.
Great. James Clear, Atomic Habits. Now, he sends me in my inbox every Friday quotes, motivations, and ideas. So you get 3 things, and the idea. One of the things is it takes a very small change, minor change, but like compounding interest, you take one change every single day. It actually has this massive ramifications. It compounds. So it's the same as getting your mindset right around your finances, changing a little habit, and that habit then has effect on other habits. Absolutely. And so on and so forth. So if you are going to be doing anything to change and future-proof your finances, the first part is changing your, the way you're managing your money.
Yeah, right. That would be. You can do that right now today, and it's going to have an immediate impact.
Absolutely. I know we're giving each other a bit of a plug. We're both financial advisors. If you don't want to talk to us, that's fine. But you've got to get hold of someone and have a chat and get advice. I do believe it's invaluable. I mean, we all have to earn a quid here and there, but I look at it and go, well, if my client that, for example, who had a massive loss in March, she hadn't come to me, and we didn't pick that issue up, that $200,000 loss will never be recovered.
Yeah.
It would just keep being, it would actually have slowed him down by years. Yeah. So,
and probably would have sold that investment at a much anyway. And crystallize that loss. Yeah.
So, you've got to look at all of it. That's a great concept of crystallizing loss. Got to look at it from all different angles, but it's important that you be proactive around your money. When this is a time where we cannot be complacent. I think
And
everyone's learnt that lesson.
And I'll add to what you're saying as well. As you're talking, and I'm thinking, oh, hang on a second. You know, I've got five girls, right? I've got 5 daughters, and I'm thinking, actually, the other part to this as well, we haven't spoken about this, maybe from another podcast, is, you know, you've got to have sit down with your partner and really make sure that you both have the same goals and you both go to the same places.
Yeah.
But I'm also very conscious about the fact that, you know, we have the divorce rate in Australia is over 50%. And typically it's the women that get the short end of that stick, right? You know, you end up, you know, you haven't taken time to look after your family, look after the kids, you know, in the workforce, and he's got, you know, experience and all that kind of stuff. And typically women do worse out of that situation, right?
Yeah.
And it takes them, and not only that situation, but going forward, you know, let's say you've given up working in a corporate environment, you haven't got the same skills, you can't get those roles again, you tend to end up in a worse place. So I'm not saying plan for divorce, but, you know, you should start thinking about, well, you know, you should start taking charge of your financial future together, if that makes sense, right? So that way, to make sure that you secure your future as well. You know, yeah. So that's something else from the podcast, but I'm thinking
it could be an entire episode. You know, there's a email that I follow, sort of a media group called Financy, and she came from the AFR. So she was at Australian Financial Review. She has a Financy index. So that index actually calculates where women are sitting in terms of financial equality. There's a massive gap between women and men. I think it's about 42% between our retirement savings. So that's quite massive. So I agree with you on that. Women do to get the short end of the stick. I work with a lot of divorced women, and I've myself been divorced, so I know what that's like. And raising kids, you work part-time or you don't work at all.
For your family.
You do. You sacrifice a lot for your family, but the biggest financial biggest sacrifice, I meant to say, is your finances, is financial sacrifice.
Yeah.
So it's really important with your partner to work on, you know, how are you going to fix that gap and, you know, along the way as well. And one of those strategies I've got my clients, and I could talk all day, and I know we've gone well over an hour here.
It's fine, right? Well, it's a good conversation. Yeah.
And we could probably do this in 2. But one of my clients, one of the strategies, she is back in the workforce and she is earning nearly $100,000, and his super's doing really, really well. But their kids have just left the nest, and you know they haven't got much in terms of costs anymore, like for the kids. So she can salary sacrifice a lot of money.
So being able to rebuild.
Correct.
Correct.
Yeah. And she's encouraged to do. She's actually really wanting to do that. So she's happy to do that. You know, it means that he's going to be doing more of the household spending, and that's okay. That's all good. So we've just reshuffled stuff. So these are the things that you can do with an advisor, is restructure the way you spend, salary sacrifice, all of that kind of thing. No one size fits all.
There's a value. That's the value of advice, right? Is to get you to a much better place than, you know, than where you're headed for. But you've got to have goals, right? You've got to have goals, and you've got to be motivated to. Because I don't like working with clients who are not motivated to achieve their financial goals. I want them to be part of the journey, not me being the driver and, you know, the
chasing them. 100%. I'm with you on that.
So definitely it's a partnership.
Now I'll recap the key things. We're going to put a little fact sheet on the website, and I'll send that to Frank so he can put it on his. And we will be doing a webinar, and I'd love feedback on what things you want to hear from us in the webinar. But recapping is cash flow is king.
Yes.
Savings, safety net. Refinance if you can, if you've got a mortgage. Take advantage of these low interest rates. Clear unnecessary debt like credit card debt and whatnot. Grow your wealth once your safety net's built. Build on top of that with a wealth creation plan. Know your super or your retirement savings plan. Understand how you're invested. Make sure that your investment plan is working for your goals. So understanding, we talked about, Frank put it beautifully. You've got, if you're at retirement, you've got your, your cash there, and then you've got sort of a more conservative, structured investment plan for the short term, and then more of a growth plan for the long term that can ride through the volatility. Understand that that's how these, the investment strategies can work for you. So they're the key things. I think that was 8 points there.
There's quite a fair few, yeah.
Yes, so they're hopefully good now for you guys to take on and future-proof your finances. Thank you so much, Frank, for sharing this spotlight with me. It was really great talking. Yes, it has been fun. Yeah. I think we've got to do a few more of these, and I look forward to doing this webinar.
Yep, wonderful.
All right, take care.
Bye.